Hello. In this video, we'll consider the tax consequences of the sale and transfer of partnership interest to both the selling partner as well as the partner that will be buying the partnership interest. It's important to understand that this topic covers the lateral sales and transfers. The lateral sales and transfers from one partner to another new or existing partner. This does not apply to transfers back to the partnership of a partnership interest. That will be considered in the distribution topic, which is another video. So we're just going to consider the consequences of both the seller and buyer of the partnership. There are no respective consequences to the partnership itself. All that happens with respect to the partnership is that you're going to see is that the partner steps into the shoes of, the new partner steps into the shoes of the old partner unless we have a special 754 election that is made. So here's the outline of code provisions that apply. And these apply to both the selling partner and the buying partner. So section 741 deals with the sale of partnership interest, and it says it's capital. Now, all sales or exchanges in the Internal Revenue Code follow section 1001, which is amount realized minus adjusted basis, gives us realized gain or loss, which under 1001C will be recognized unless some other provision. I'll tell you right now, there's not going to be any provision out there that allows for non-recognition with respect to sale of a partnership interest. So it will be recognized gain or loss as well. Now, section 741 deals with characterization of that, and it says it's capital in nature. However, under section 751, specifically 751A, because 751A deals with sales or exchanges of partnership interest, 751B deals with distributions. So 751A says that ordinary income treatment, though, applies to special 751 assets, which are unrealized receivables, which we have to define, and inventory. Now, we're going to have to define these specifically for sales. Note that distributions, they could have a different definition. Now, 754 is a special election the partnership. Please note that the partnership can elect to adjust the inside basis of property, underlying that for the interest that's sold. Now, section 742 applies to the buying partner in terms of the basis the buying partner takes and the new interest that he or she has. And what usually happens is they take a cost basis, and you'll see they're going to step into the shoes with respect to the inside basis in the partnership. Section 743 deals with the basis adjustment for a 754 election, as well as 755 is how to apportion the basis adjustment. Now, there's a special rule under 708B1B. I'll mention that the Tax Cuts and Jobs Act of 2017 repealed this rule. What you see here is prior to 2018, and now 2018 going forward, there is no constructive termination when you meet these requirements. So let's first start by calculating the gain or loss to the selling partner. That's the first place you should start. So again, section 1001 determines the amount realized minus the adjusted basis, gives us a realized gain or loss, which is going to equal the recognized gain or loss in this situation. So amount realized minus adjusted basis gives us that gain or loss. That gain or loss if it's negative, which will be recognized and shown on the tax return. Now note that the concepts we've learned before about what is amount realized, what are basis, those go into there. And that's really what this is, including a partner share of debt. A partner share of debt can go into the amount realized because any relief, if the partner is being extinguished of any liabilities, even with respect to the partnership, that portion goes into the amount realized. Characterization. So once we get the gain or loss, characterization is determined under section 741 or 751A. 741 or 751A. There's really a three-step process when you're calculating the gain or loss with respect to the selling partner. So, and I want you to know these steps. There's three steps. Step one, we calculate the overall gain or loss. The overall gain or loss, which is simply just the section 1001 calculation, which is that right there, right? The amount realized minus adjusted basis. Step two, we determine which portion is ordinary under 751A, and step three is to take number one minus number two, and that will be your capital gain or loss, which is applied from section 741. So the idea is that you calculate the overall gain or loss. The portion of that under 751 is treated as ordinary. That's attributable to inventory and unrealized receivables. And then whatever is left is considered capital gain or loss to get those numbers. Now, it's possible you can have an overall loss, you can have ordinary gain, and then you'll have a capital loss. That's possible. It's a bad situation, but it's possible. So section 751. So step one, right, which we just talked about, is just to calculate the section 1001, and you know how to do that. Amount realized minus adjusted basis. Again, you include any relief of debt in the amount realized. So now step two, we're talking about what portion is with respect to the ordinary items, the ordinary gain or loss. So section 751A says amounts received in the sale of partnership interest are ordinary income or loss to the extent the underlying assets are unrealized receivables or inventory under 751C. Now I want you to note that inventory for 751A purposes, which are sale or exchange of partnership interest, is all inventory. You're going to contrast that with the next topic on distributions, where it has to be substantially appreciated, which is 120% or greater. That's extremely important, just so you know. Now, unrealized receivables is really important to understand as well, because you might be thinking, okay, I know exactly what that is. That's accounts receivable. It doesn't just apply to accounts receivable. It also applies to recapture items and collectibles gains. So that means section 1245, recapture, or collectibles items, collectibles. Now the one you really have to pay attention to is that 1245 recapture, recap. Definitely pay attention to 1245 recapture. The portion that's 1245 recapture will get hit with this ordinary treatment. So the last step, once you calculate the ordinary portion, again, is to take number 1 minus number 2, and again, under section 741, that portion will be capital gain or loss. So now some additional issues for a selling partner, and these are kind of beyond the scope of the general discussion, but outside basis of sold interest must be adjusted for seller's share of profit or loss through the date of sale. So this is what happens if you have a, throughout the sale, like throughout the year, you have to adjust first before the sale takes place for any profit or loss. So you have to allocate. You have to allocate those Section 704 distributive share items. If a sale of an entire interest closes the year for the seller, you got to look at the flow through of income, which is along the same issue. And the sale of partial interest does not close the year. So the issue becomes, do we close the year for the taxpayer? Generally speaking, yes. But if it's a sale of partial interest, no, it does not. This is just a special issue. What if a selling partner has more than one interest? I just put it on here just so you can keep, this is a special issue. And again, it's beyond the scope of our general discussion. Rev ruling 84-53 applies the applies the analysis to this fact pattern. The holding period for a sale of partnership interest is measured by the partnership interest, not the assets. You can have split holding periods, as we know from the contribution or formation, because you might have capital assets or 1231 assets that are contributed. So it's going to make a difference. And installment sales treatment is available, except for underlying 751 assets, which will get automatic. They'll get automatic gain recognition if there's gain, automatic for 751. So the tax consequences to the buying partner. So first thing is that the outside basis is whatever the partner pays. That's important, or whatever liability. So it's the cash paid plus liabilities assumed. So remember that under section 752, any liabilities taken on or subject to, I said assumed, or subject to, they will be considered as cash contributions. Now section 743 deals with the 754 election. So 743 deals with the inside basis will be unchanged. So the partner, so if no 754 elections made, the buying partner will step into the shoes, regardless, step into the shoes of the previous partner, unless a 754 election is made, and then it will be adjusted. Now 708B1, that's going to be beyond the scope, but it's what happens if continuing partners with respect to the year. The Tax Cuts and Jobs Act of 2017 repealed this rule. What you see here is prior to 2018, and now 2018 going forward, there is no constructive termination when you meet these requirements. So the way that the operation 754, 743, and 755 work, this is the election. If a partnership, that's who has to make the election, makes a Section 754 election for the year, in which a 743 or 734 is the distribution adjustment is to apply, the election is permanent for life of the partnership. You can't go back on that. That's the key. So the reason is that you're going to see that when there's gain property, having a 754 election is good, but when there's lost property, it's not so good because it adjusts the numbers with respect to the partnership. Section 754 turns on the basis adjustment of 743. The amount of the 743 adjustment is determined under the regs, and it's really complicated in some situations. But what it really does is it gives the buyer a full inside basis, as if the buyer had bought his share of assets new, and then the inside basis is adjusted for that. 755 prescribes the allocation, how we allocate. So the simplified analysis is that the basis adjustment for each asset, so you have to do it by each asset in the partnership, inside the partnership, is the gain or loss to the seller on a hypothetical sale for the fair market value. Note the buyer can have offsetting gains and losses in various asset classes. So the idea is that you adjust with respect to the portion just for the seller, just the seller's portion. So we adjust the seller's portion. We just adjust for the seller's portion. So if there's three partners, A, B, and C sells his or her 1/3 interest to D, you only adjust for the 1/3 portion. You don't adjust for all of it because you still have A and B there that might have been there since the beginning, and they might have that discrepancy in there. So we just do for the seller's portion, not for everyone's portion. So here's an example. So let's consider first what happens if there's no 754 election and with the 754 election. This is a very basic example where we just have one asset, accounts receivable. And you see that we have A, B, and C who each have a adjusted basis and their partnership interest is 0, and they have a fair market value of 100 in their partnership interest. So A, B, C, partnership is owned equally, right, 1/3 by A, B, and C. C sells to N, who's the new partner, for $100. So if there's no 754 election, C has $100 of ordinary income. How do we do that? Well, step one, right, it's the amount amount realized, which is the $100 of cash. There's no liabilities here, so we don't have to include that. So that's the amount realized, minus the adjusted basis to C, right, which is 0, right? That gives us $100 of gain. Step two, we apply 751 with respect to the asset. There's a $300 asset, right? It's accounts receivable. That's a 751A asset. So we take 300, which is the accounts receivable fair market value, times 1/3. That's 100. And the basis is 0, so 0 times 1/3 is 0. 0 times 1/3 is 0. And we're going to subtract away that 1/3 portion of the basis. And that gives $100 ordinary income to C. And then step 3, we take step 1 minus step 2, 100 minus 100 is 0. So that means there's 0 capital. So this was ordinary, right? That's step 2. Step 3 is capital amount, which there's none, so there's no capital gain or loss to C. Now, N has a new outside basis of $100. How? Because that's what N paid. ABC, though, still has a 0 inside basis with respect to accounts receivable because there's no 754 election. Also, now, N comes in and steps into the shoes of this account. So outside the basis of the partnership, the new partner, N, has a $100 outside basis. However, inside they do have 100, but there's no discrepancy. See this discrepancy here? This is the inside basis, which should be adjusted. There's only one asset. You can easily see it. So this was adjusted for N, the book tax amount was 100, right? Because N's a new partner, 100, 100, right? If N sold his or her partnership interest, right, then you have that because of the outside basis. But what happens if the partnership collects the full accounts receivable? Well, then each partner is allocated $100 of ordinary income. Why? Because we have this $300 amount, we have this zero amount. See that? So it'd be 300 minus 0, which is 300, times 1/3. Each partner gets $100. That $100 under Section 705 of gain is going to increase N's basis by $100. So now N has $100 plus $100 outside basis, which is $200. So this will actually go up to $200. And then if N sells, which the value is $100, guess what? N has a capital loss of $100, which is not good because N had to recognize ordinary income of 100 and now has a capital loss of 100. That's not good because, as you remember from basic tax concepts, you can't offset a capital loss against your ordinary income, but only like up to what, $3,000. But if this is hundreds of thousands of dollars, then guess what? N's going to be out of luck for $97,000 because N can only use 3,000 of that. So that's a real bad situation. So that's basically what 754 remedies. Okay, and this slide really goes through that. It talks about it's an uneconomic tax treatment to N. N is the one that's affected here if no 754 election is made. If they do make the election, then it's going to be adjusted. It's going to be adjusted with respect to those numbers. So what you see now is with the election, you get to increase the adjusted basis of the accounts receivable up, and when the accounts receivable are sold later on, right? So this now actually is N, who's new party, so that makes sense. 100, 100, that equals, right? Because N bought into the partnership, so those accounts receivable have already been taxed because guess who got taxed on them? C. So the accounts receivable there, when they're sold, they're going to be a 300 minus 100, $200 gain. But guess what? N doesn't get hit with it. Only A and B. So A and B each get 100. Why? Because N previously was taxed on that when N purchased in because C was taxed on it. So A and B have the tax of the $200 total of the gain. And that's how it works. That's what Section 754 does. Now you're thinking out there, why wouldn't you do this? Again, if there's a loss situation, it's actually bad because you get to basically N loses the loss. So if there's a loss in here, N doesn't get to take the loss. So it's really, it's a two-way